And there you have it, the sound of the closing bell at the New York Stock Exchange.
That's right, signaling the end of not just another trading day, but another trading week there on Wall Street. Let's see where the numbers are landing right now. It was an up and down day for the Dow, but you see that it ends the day in positive territory, up more than 130 points, but it did end the week down. The tech-heavy NASDAQ and the S&P 500 didn't experience the same gains. We understand the NASDAQ closed down roughly 0.5%, the S&P 500 in the red also around 0.25%.
So let's bring in JD Durkin and Javier David now. JD is the host of The Street, and Javier is a CBS News contributor and the managing editor of Business and Markets for Axios. Welcome. Happy Friday to you both. Yeah. JD, let me start with you. So as Errol said, bit of an up and down day. What was driving the markets today?
Well, it's interesting just to take a look at some of the Dow 30 components that are on the upswing at the end of the day. You got your top healthcare stocks, some of your tech stocks helping drive down that particular index. But really, we've been in mixed territory throughout the day. I think investors are really battling a ton of kind of conflicting data points. And top and foremost of mine has been these really high inflation numbers. The consumer spending element is very strong with these retail sales figures that we got earlier in the week. And for all the bullishness that we've had over the course of the first 6 weeks or so of the trading year, I think investors are starting to come a little closer to reality with the central bank, dare I say. The writing is on the wall. The Fed is clearly communicating those short-term interest rates will be going higher for longer. For people at home, that means those credit card balances you pay off month to month will be more. And I think investors are starting to kind of come down to reality a little bit. And now we're eagerly going to pay attention to what the Fed does at its March decision. And there's a possibility of a 50 basis point hike in March, which is not something investors may want to see, but may ultimately be what the Fed feels like it needs to do to get a better grip on inflation.
See, that's really interesting. Javier, help us understand how some of the what JD's describing as conflicting data is factoring into the way investors are thinking right now, because we do have what seems to be slowing inflation. The job market is improving, but how are investors either already factoring it into their decisions or changing what they're about to do next?
Well, what I think the takeaway from this week's sort of roller coaster ride on Wall Street is markets are actually sort of betting that the economy can withstand these higher rates, that the Federal Reserve, first and foremost, I think we should make the distinction between inflation that is sort of easing and inflation or prices falling outright. And so we have an easing inflation, but that's not the same as falling inflation, two completely different things. And that's why, as JD mentioned, the Fed is nowhere near done, and they are communicated that. They've been very clear. Maybe next meeting we have a 50 basis point rate hike in the offing. But I think the biggest thing is markets are trying to calibrate what really appears to be a Federal Reserve which is committed to its mission, which is taming inflation, but the fact that all of this data that we got over the last 2 or 3 weeks has been well above expectations. The inflation data obviously is very negative, but the jobs market still incredibly healthy, impossibly healthy, really. Really suggests that markets are betting on the idea that, okay, even if we get to 5, maybe even 6% on Fed rate, maybe we will be okay after all.
It's another good reminder that so much of what happens on Wall Street is speculative, right? It is emotional. It is about where their mood is. JD, I want to ask you about some of the, since we discussed job numbers, you've got some of the world's largest tech companies struggling, laying thousands of people off. But a new report this week noted that streaming platforms are outpacing broadcast media. So what can you tell us about that and what it means to our economy and the numbers we're seeing?
Well, I mean, in terms of the tech layoffs, I think there's a reason that a lot of people are now wondering if this is, at least for right now, or dare I say, a bit more of a tech session, or what some people call a rich session, as opposed to a regular recession. In other words, these are white collar, they're higher paying jobs, and these are a lot of companies that added on a lot of employees in the pandemic. You got your Googles, your Amazons, your Microsofts. But what's interesting is you look at other sectors of the economy like food and hospitality. Those are the parts of the economy that took the hardest hit in 2020, yet you're not really seeing that same level off. We got a historic level of unemployment that we haven't seen since 1969. So yes, these companies in either media, in finance, or tech, of course they are going to get outsized attention as we talk about tech layoffs. We're just not really seeing that work itself into other parts of the economy. I mean, to the point about streaming, hey, that's been the story of this new generation. It's cord cutters. It's people that are moving away from traditional cable and broadcast. they're getting their news, they're getting their sports in more digital avenues, whether that's through smart TVs, their computers, or their mobile devices especially. And I think everyone's just trying to really see where the puck is going, especially for a lot of these companies that find themselves right at the intersection of both of these storylines.
So, Javier, JD calls this a tech session, right? So with streaming on the rise, it would seem that you wouldn't have layoffs in the tech sector, right? Because don't they need those folks? As there is this increase in streaming, don't they need those workers in order to move forward?
They actually do, but I think a lot of what we're seeing in the tech sector is a retrenchment or a reversion to the mean. A lot of these big name companies, they overhired, they all have admitted, we overdid it on spending. We kind of believed that the pandemic boom times were going to last forever. Now we have to pare those jobs back. So in some regards, what they have left is, I guess, sort of enough to keep the trains moving, so to speak. But a lot of these jobs, the people that have lost jobs, they're finding work. Two things are happening. First and foremost, they're getting pretty generous severances in a lot of cases. They don't have to or feel obligated to apply for unemployment right away. They're not, not on the breadline in any form or fashion. The second is there are other sectors of the economy that need tech workers or tech skilled workers, and they're still hiring. So a lot of these people, and based on the real-time data that we get every month from the JOLTS data, which shows you how many jobs are open and how many people have left their jobs, you're seeing that still there's 2 jobs for every 1 person that wants one. So these folks, despite the fact that they're getting laid off, are either living well off of the severance or they're getting another job in another sector right away.
Federal government, a major employer of tech folks, and they're looking to snatch up some of these newly laid off tech workers. JD, we haven't discussed crypto markets as much, really, since the crash of FTX. Where is crypto today?
I mean, it's amazing. I don't know how many people saw this coming, but it's been on a huge run here over the course of really the last few days. I think there's a lot of people that thought the general crypto markets kind of bottomed out back in November. Obviously, you have the FTX collapse and how many other companies that ensnared, how many other employees that may have been, working for companies that were 2 or 3 companies removed from FTX, but they were directly impacted as well. I was taking a look at the numbers for Bitcoin last night at 23,500. At 8 a.m. today, crossing about 23,900. And the last time I checked, a short time before we came on air, it was right about 25,000 here. This despite the fact that you've got renewed regulatory pressure at the same time. The New York State Department of Finance and the SEC are making headlines nearly by the day about trying to crack down on bad actors in the crypto space. But for people who have been longtime holders, or as they like to call themselves, hodlers, over the world of cryptocurrencies, they actually feel pretty bullish right now because we've actually seen the numbers begin to trend up, at least in the last couple of days or so. I mean,
Javier, to me, that's counterintuitive because if you look at what happened with FTX and as JD points out, the landscape, right, with regulatory pressures, I would think that some people are a bit nervous, right, about that. I mean, realistically, what is that about? Because to me, and maybe I'm perhaps quite conservative, but like I wouldn't necessarily feel quite as confident as an investor in that.
A few things. I think what you're seeing is kind of a disaggregation in crypto of all of these there's a lot of bad actions, a lot of illicit activity that's been taking place over the last year. Some of the coins that were were just kind of sketchy, let's be honest.
Let's be honest.
But Bitcoin is kind of like, you're seeing sort of the cream rising to the top. Bitcoin was always going to be sort of the avatar of the sort of coming world of crypto, the utopia that the maximalists envision. There's a lot of bullishness in the market because it looks like the data, we're not going to head toward recession, or maybe there's a new lexicon that was sort of a new phrase that's entered the financial market lexicon, which is no landing, which is the economy is going to sort of keep cruising at a relatively healthy pace. And so people are betting on that. And so crypto really is, regardless of what its proponents say, it's a risk asset. So it's trading a lot like the stocks market. It's very speculative, but I mean, there's a lot of bullishness.
All interesting stuff. Great to chat with JD Durkin, who is on the floor of the Wall Street, New York Stock Exchange, and to have Javier David here with us in studio was always a bonus. Thanks to you both, gentlemen, for joining us today.
Thank you.